Hello and welcome to Financial Intelligence. In this video, I want to talk about the Chinese debt crisis. Usually when we talk about debt and financial crisis, we immediately think of the US and its financial crash of 2008. However, unfortunately, the US is not the only country where debt levels have risen dramatically. China, the world's second largest economy, in some sense is in a worse shape than the US. Chinese corporations such as Evergrande are defaulting on their debt obligations. Evergrande is just the tip of the iceberg. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. When we think about China, we usually imagine an economic superpower that is about to surpass the US in the near future. While the Chinese economy has been super strong and growing at an impressive rate, there are cracks that are appearing. When we dig deeper to understand how the Chinese growth engine was powered in the past decade, we will recognize that its trajectory is unsustainable. What is the problem exactly? In the late 2000s, China's economic growth was driven by massive government-sponsored infrastructure and property investments. Most of these projects were funded by debt primarily supplied by government-owned banks. The challenge is that most of this debt is tied in low-returning or unproductive assets incapable of servicing the borrowings. The scenario is very similar, like someone taking out a mortgage to buy a rental investment property, but then they realize that the rent revenue from the property is lower than the mortgage payments on the loan. During the past few years, borrowing by Chinese corporations has exploded to extreme levels. When an economy grows at the pace Chinese did, the abundance of opportunities promotes corporations to borrow funds so that they can take advantage of those opportunities. For example, Evergrande, the largest Chinese real estate developer, has 7 units dabbling in a wide range of industries, including electrical vehicles, healthcare services, consumer products, video and television production units, and even a theme park. As long as the Chinese economy was growing at speed, revenue flows were more than enough to keep up with the debt burden. But that time is now over. The required growth rates are now unattainable. Since China's economy has begun to slow down, revenues have declined and those debts have become increasingly difficult to sustain. At China's current debt levels, which are rising around 12 to 15% annually, growth of 6% is required to simply keep the debt to GDP ratio stable. The growing list of defaults testifies to this reality and points to still more trouble ahead. How big is the problem? To put this into perspective, China's overall debt was 270% of its GDP at the end of 2020, up from 247% a year earlier. Foreign debt reached $2.4 trillion in 2020. Since 2008, Chinese borrowing, mainly by businesses and households, has risen by almost 100% of GDP. As shown in this chart, corporate debt now accounts for 2/3 of the total Chinese debt. Certainly, the news coming out of China is disturbing. Evergrande, the giant property developer, has made the biggest headlines, understandably, since it is the largest of the troubled firms. But Evergrande is not alone. Evergrande's outstanding debt of more than $300 billion constitutes less than 1% of China's total debt. If the news of looming default by Evergrande has rattled the markets this much, you can imagine how much of and impact the Chinese debt crisis could have in the future. However, note that this is not just China's problem. The global financial markets are so intertwined these days that it is impossible to have meaningful containers of risk. The entire system is codependent like pieces of a domino set. In other words, a failure in one part of the system can easily propagate through the system and create shock waves across the financial world. Therefore, Chinese default can have global implications. For example, investors in Chinese stocks and bonds, either directly or through emerging market ETFs or funds, are at risk. US and European company earnings rely on Chinese markets for growth, leaving export-oriented businesses such as automobiles, industry machinery, aerospace, technology, and luxury products exposed. What makes things even worse is the lack of transparency as how much risk Chinese debt poses to the global markets. Still more threatening is the likelihood that these troubled Chinese firms are part of a larger group, many of which remain unknown. Moreover, international lenders may not be willing to help the troubled Chinese firms because of their convoluted financial structures. I hope that you like this video. If you have any recommendation or suggestion, add them in the comment section below. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you won't miss any of my future videos. Thank you and take care.